Fixed income is increasingly sensitive to macro-level market developments. For most of 2012, pressures in the Eurozone have impacted on bond prices and spreads, both corporate as well as sovereign bonds. What's been the impact of the resulting volatility on the volume and complexity of fixed income transitions this year?
We've certainly seen heightened volatility in bond spreads and pricing this year, and what is perhaps less observable is the impact that that's actually had on liquidity as well. That constrained liquidity has been proving a significant challenge for implementation, and it's perhaps exacerbated by the restricted investment bank balance sheets and also increased demand from pension funds for corporate bonds and high yield asset classes. So, like I say, that has provided some significant challenges, and those market conditions just serve to highlight the importance of having multiple venues for sourcing liquidity. A provider such as Russell will look for liquidity across a wide variety of counterparties, but that's not enough. It's not enough to say that you will get a better result by polling 4 or 5 counterparties. If they're not interested in the trade, you're going to get 4 or 5 bad prices.
Can you tell us about some of the solutions?
The nice thing about engaging with a provider like Russell is that we can't do anything to take advantage of the information that's provided to us as part of a transition. As such, our counterparties are very happy to share a lot of information with us about what bonds they're active in, what sectors they're active in, and we're able to collate that information at a security level or a portfolio level and make sure that we're making very targeted approaches to our counterparties. So we aren't going out to 4 counterparties that are uninterested in the trade. We're going out to 4 counterparties that we know are going to provide us with competitive pricing, and therefore we're achieving the best price for our clients. Additionally, we look at things like referencing the economic calendar. It's really important with quite extreme reactions seen intraday for us to ensure that we're not starting a transition trade on a day where there's a whole heap of economic data expected. What we often see is counterparties will sit on their hands for the morning leading into an announcement, and then you'll see a spike in volatility. We don't really want the first day of a transition to be a day like that. So it's really important for us to make sure that we're referencing the economic reporting calendar to make sure that we're mitigating some of this volatility risk.
In volatile markets such as these, how do you best mitigate the effects of credit shifts during a fixed income transition?
Managing credit risk is actually quite challenging from a transition perspective because there are quite limited investment tools available to us to manage that within the framework of a transition. What's really important at the outset of a transition is to undertake a detailed risk analysis so that you understand what is driving the risk between your legacy and target portfolio. It may be credit risk, it may be duration risk. From there, once you have a very good understanding, you can start to develop a risk management strategy. There are tools available to us to manage credit risk, such as credit default swaps, but these don't tend to lend themselves that well to transitions because of the complex legal documentation that's required, and they can be quite costly. So what we tend to find is we'll engage our traders early, and because of our business model, we're able to, because they can't monetize the information, and really look for their input about an optimized trading solution. So we can try and trade out of certain high risk positions and correct some of the misweights in the portfolio early on in the implementation and look to really bring that tracking error down. There does need to be, in volatile markets, some degree of flexibility as well. Our job as a portfolio manager isn't done when we hand over the trades to the trading desk. We need to make sure that we maintain very close communication with them, and if credit markets evolve during the transition, we are constantly looking at the strategy and adapting it and making sure that we're keeping sight of the client's overall objectives. That's really important for us during the transition.
You hear more about multi-asset transitions these days. How common are they? What are the peculiar challenges of transitioning a multi-asset portfolio?
Whilst I think the transitions business was predominantly equity focused 5 or 10 years ago, we've certainly seen a pickup in fixed income volumes, and that's really occurred as clients have dedicated a greater proportion of their assets to fixed income based strategies through perhaps a longer term de-risking strategy that they may be employing. Multi-asset class transitions, it's kind of hard to quantify what the increase has been, because it may be that actually clients transitioned the fixed income proportion of their assets some years ago through cash. I think as they have got to understand the complexities and the need for transparency within this asset class more, they've been more inclined to engage a transition manager. And also fixed income portfolio managers are a lot more comfortable working with transition managers as well. It's really important when looking at a multi-asset class transition that you engage a provider who has a multi-asset class platform, so that they can look at risk and also cash and exposures on a holistic basis. Quite often, when a client is undertaking a multi-asset class transition, they're doing it in the context of a wider de-risking strategy. So they're not necessarily looking to engage a transition manager in the traditional sense, but looking for more of an aggregate exposure management provider who's able to offer a multi-asset solution for them.